Inflation and housing prices are linked to one another. In fact, inflation is linked to any good or service in limited supply. Consider an economy that has a money supply of only $10 and 5 identical houses in the entire economy. Each house would be priced at $2 because there would be no other homes available. Now suppose the central bank, Bank of Canada, decided to print more money and the money supply expands from a total of $10 to $20. Now each house would be priced at $4 because the money supply has increased, but the supply of houses remains the same. This example is simple, but through increasing the money supply, it caused inflation and house prices to increase. There are a lot more factors that affect housing prices in reality. One of those factors is causing home prices to increase is interest rates. When interest rates are low, buying homes can be more affordable and increase the demand for homes. If the supply of homes remains steady and the demand increases, then the prices for homes will increase as well. In large cities like Toronto, where land availability is limited, you can see a more visible effect of inflation. The Toronto Regional Real Estate Board released GTA sales data for November 2021, and it showed that compared to November 2020, new active listings were down 13.2%. Sales were up 3.3%, and prices were up over 21.7%, showing the visible effects of inflation. So, if you are an owner of real estate or aspire to be an owner of real estate, what does this mean for you? Interest rates will rise. As inflation goes up, central banks typically raise short-term rates to put downward pressure on the inflationary environment. The hope is that with less consumer consumption, inflation will ease. Asset prices will rise. As the price of things increase with inflation, so does real estate, making it more difficult for entry-level buyers to get into the market. Inflation causes construction costs to rise. Because things get more expensive with inflation, the cost of materials used in construction will rise as well. If you are planning to buy a new build in an inflationary environment, your costing will need to account for the inflation of the building materials and labor, leading to a higher price for new homes. Residential outperforms during inflationary periods. The good news for investors with single-family homes, condos, and multi-family properties in their portfolios is that these assets tend to outperform in inflationary environments. Real estate is seen as a hedge against inflation, as it tends to outperform most asset classes during inflationary periods. Renters pay the price. As inflation increases in various goods and services, so do rents. In environments without a rent cap, meaning a ceiling on the maximum increase a landlord can increase rents by, rents can rise at the rate of inflation. During historically high periods of inflation, this can put a heavy burden on renters and their standard of living. An inflationary environment can be positive for real estate investors if they make smart acquisitions and stress test their portfolio against inflationary pressures like rising interest rates. And right now, with far more demand than supply, you can expect your assets to continue to increase in value, but also the cost associated with it will go up too. My name is Jeff Ajimai, real estate broker with Home Life Miracle Realty and founder of House of Trade. Let us know what other content you would like to see by commenting down below. For more content like this, like, share, and subscribe to our YouTube channel and follow House of Trade on Instagram at House of Trade Inc.